Hi everyone, it's Matt McLennan with Kidder Mathews Commercial Real Estate in Tacoma. I've been getting this question a lot lately, so I thought I'd address it, and it's people asking, Matt, what's going on in the residential real estate market and how is that going to affect the current conditions of the commercial market? Well, I'll be the first to admit I'm not an expert on the residential market. Obviously, I track it closely, I pay attention to it, but I'm not the expert. But that being said, I think it's pretty obvious that what's going on in the residential market is, if you boil it down to its most fundamental sense, supply and demand. And if you look at the city of Seattle, Tacoma, a lot of the major cities across the entire country, most cities frankly, we have a supply problem. We're undersupplied compared to demand. So people have been looking at the rising interest rates, the changing economy, the anticipation that we're heading towards a recession or other economic doom and gloom, and wondering why aren't housing prices coming down. And it's exactly what I just said, supply and demand. So long as we are undersupplied and supply remains low and demand remains high, prices are going to hold. They're probably going to increase, frankly, even though cost of capital and everything else has gone up. So how does that translate to the commercial market? Well, the commercial market historically has followed residential markets as far as when residential markets go down, commercial markets go down. I believe, based on what we're looking at today, that may or may not be the case as far as what's going to happen here in the future of the commercial market. And the reason mostly being it has to do with debt, right? And the biggest change we've seen in our economic environment are these rising interest rates. And commercial loans as opposed to residential loans, typically a residential loan, most of them are 30-year mortgages with a fixed interest rate, whereas commercial loans might be 3 years, 5 years, maybe 10 years of debt term. And so we've all been hearing about in the news, a lot of these commercial loans are getting ready to turn over. And when they do, owners are going to have to refinance at new interest rates. Their debt payments on a monthly or annual basis are going to skyrocket. Meanwhile, their income from the building may or may not have gone up accordingly with that increased debt payment. Debt service coverage ratios are getting more aggressive from the banks. People are going to have to bring money to the table, or the buildings are probably going to go back to the banks, have to be sold to cover things. It's going to be really interesting to watch this. And again, this is nothing necessarily new, but as it relates specifically to the residential market, which again is the question that I keep getting, it's really interesting because the two don't feel as tied together in the current economic environment as they have been in the past. It seems like residential, despite everything going on, is going to be okay for the foreseeable future, different than it was before, but okay at the moment. Commercial has a big question mark, which again, our fundamentals are really strong, especially in the Seattle industrial market specifically. And so reason carries that we're going to be okay for the foreseeable future, but it's a big question mark what the real next 12 to 24 months are going to look like. So let's all watch it together, and would love to hear your thoughts on this one as well. Thanks.